Welcome to our channel. Today we're delving into a financial metric often heard but perhaps not fully understood by many. EBITDA, otherwise known as earnings before interest, taxes, depreciation, and amortization. A mouthful indeed, but a term pivotal in the world of finance and corporate earnings. For the uninitiated, EBITDA might seem like a dry number, tucked away in the financial reports of big corporations. But there's an intricate story behind this figure. One that dances between genuine financial insight and, at times, clever accounting. The story of EBITDA begins with its intention to provide a clearer picture of a company's operational profitability. By stripping out interest, taxes, depreciation, and amortization, EBITDA aims to showcase how well a company is performing from its core business operations alone. It emphasizes the raw engine of a company, free from the noise of financing and accounting decisions. The appeal is straightforward, a simpler, cleaner view of earnings that enables easier comparison between companies or across time. However, beneath the surface of this seemingly straightforward financial measure lies a more nuanced landscape. To outsiders, it might be surprising to learn that financial figures like EBITDA are not just cold, hard facts, but can be the subject of manipulation, often through strategic yet questionable accounting practices. This management of earnings, often called earnings smoothing, is not merely a cynical exercise. It's a high-stakes game of maintaining investor confidence and meeting or beating market expectations. For many executives, it's a balancing act that could determine the stability of their careers. Let's take a closer look at how EBITDA can become a tool for such financial maneuvering. One method is through altering depreciation schedules. Since EBITDA excludes depreciation, companies might choose aggressive depreciation methods to improve their EBITDA numbers, offering an inflated sense of profitability. Another common practice involves capitalizing leases, thus moving them off the income statement and onto the balance sheet, which again gives a more favorable EBITDA. At the heart of this use, and admittedly misuse of EBITDA, is its lack of standardization. Unlike net income, which is clearly defined by accounting principles, EBITDA is more of a concept, open to various interpretations and adjustments. This flexibility can be a double-edged sword. It allows companies to tailor the metric to suit their true operational strengths, but it also opens the door for distortion, turning financial statements into a game of smoke and mirrors. Despite these shadows, it's essential to remember that EBITDA, when used correctly, remains a valuable tool. Investors and analysts often rely on it to assess a company's ability to generate cash flow, a critical factor in determining the health and potential of a business. It's a metric that cuts through some of the complexities of traditional accounting measures, providing a snapshot that can be particularly useful in industries with high capital expenditures. In practice, the key to using EBITDA wisely is context. For investors, analysts, and stakeholders, it's crucial to pair EBITDA with other financial data, to look at patterns and anomalies, and to be cautious of companies that consistently outperform too-good-to-be-true EBITDA measures. Transparency and thorough analysis are vital, alongside a healthy skepticism of figures dressed up too perfectly. So, as we conclude our exploration, remember this: while EBITDA can be bent and shaped, understanding its strengths and vulnerabilities allows you to see the broader financial landscape with clear eyes. Like many aspects of finance, it's a tool, and whether it serves you well or leads you astray depends on how wisely and critically it is wielded. As the saying goes, forewarned is forearmed. Thank you for joining us in this exploration of EBITDA. We hope this deeper dive has illuminated the intricacies behind this pivotal financial metric. Be sure to like, subscribe, and hit the notification bell so you don't miss our next deep dive into the fascinating world of finance and economics. See you next time.